There are various set of concepts people use when trading. For example, some people use the retail trading concepts, some use the institutional trading concepts, while others could use something they call the smart money concept. In the institutional trading concept, there are other set of many concepts people could use. For example, the fair value gaps, the order blocks, the liquidity gap concept, and much more. But in today's episode, I'm going to be teaching you how to spot the right set of order block to use when trading. Hi guys, and how you doing? If today is your first time in this channel, I say a big welcome, and if this is not your first time, I say a big welcome back. My name is Tradewithbolu from Tradewithbolu Online Services, and we are right and ready to hit and dive into some very interesting topics today. As I said earlier, how to spot the right set of order blocks in the foreign exchange market. Remember, don't forget to subscribe and hit that like button, and trust me, share this content to whoever you know needs this set of content. So we'll first be explaining what we call an order block. An order block really is just a region in price where lots of orders seem to lie, and it's a very important concept, because when trading in foreign exchange market, you notice that there are some zones or there are some points, okay, where you just discover that from this region we see a push in price, or price just seems to do a whole lot of movement, okay, and this set of regions are deemed to believe to have lots of orders, and this set of candles are what we call the order blocks. So order blocks really are just candles or candlestick points where lots of orders seem to lie. So when trading, there are a whole tons of order blocks, because there are a whole tons of orders, and most times you don't know which order block is the best one to use, or how do I select the right set of order block. And in this episode, I'm going to teach you how to do that. So first of all, one thing you have to do is what I call understand the institutional order flow. Don't worry, I'm going to break it down. Understand the institutional order flow. And what does this mean? Institutional order flow, it's more or less like the market direction of what the market is currently doing. Okay, institutional order flow, we have two types. We have what we call the bullish order flow, the bearish order flow. The bearish order flow is made up of order blocks that indicate or where you could take selling opportunities from, while the bullish order flow is made up of order blocks where you could take what? Buying opportunities from. So let me just go to my chart and show. I'm in my chart already. So for example, this is what we call a downtrend when it comes to market structure. But a downtrend most times is made up of bearish order flows, because from these regions you could take, there are different, or there are vast number of order blocks where you could take selling opportunities from. Okay, so as we see this downtrend is a bearish order flow. There are a huge number of order blocks that you could decide to sell from. But once you see an uptrend is what more or less a bullish order flow. Remember, a downtrend is somewhat a bearish order flow. An uptrend is a bullish order flow, because from this uptrend or this bullish order flow, you can decide to take trades from other blocks that would lead to a buy or push to the upside. So as I'm seeing this uptrend now, I'm seeing a whole number of other blocks where you could take buying opportunities from. So this is the first step to do. Differentiate the order flow. Is it a bullish order flow? Is it a bearish order flow? Okay, this is a bullish order flow, this is a bearish order flow. How do I know the right order block? And hold on, I'm going to put you through. So first of all, you must discover how to find an order block. Okay, that's the basis. Definitely to spot the right order block is because you've discovered other set of order blocks. So what is an order block? Okay, I've said a theoretical explanation, but now let me spot what an order block is for you of this chart. So an order block is a region where you see an impulsive move and market breaks structure. All right, so what is this? This is a red impulsive move, a bearish impulsive move to the downside. Okay, and it was taken after this green candle. So this green candle is our order block, and what happened here, we saw what we call a break in structure. Yes, this structure, okay, price formed what, a new set of lows. It took out these lows and it pushed further. So there was a break in structure to the side, and we saw an impulsive move. So this is a simple order block. Okay, there was a break in structure and we saw an impulsive move. So we can see it also here. What did we see here? We saw what? Of this green candle, what did we see? We saw an impulsive move to the downside, and we saw what? A break in structure here. These lows were taken out, and we saw a series of impulsive moves. Most times, impulsive moves will be set of candles appearing after each other, but then one thing you must also see is a break in structure. Take note of these two concepts when finding any set of order block at all before we move into finding the right order block in. Alright, so now that we've discovered how to find an order block, how do we get the right set of order blocks? So there are a series of four conditions it must pass through before we can say this is a right order block. Yes, there are a series of four conditions price must pass through before we can say this is the right order block. So the first condition I would say is the order block must have rejected off a previous order block, something I'll call like a pseudo block. A pseudo is something that is not true, something like is semi-true. Yeah, semi-true. So the order block must have rejected off a pseudo order block previously. So let me give an example. Okay, this is an example of an order block. Okay, and rejected off this order block previously. All right, this is an order block because what we saw an impulsive move that broke structure to the downside here. Okay, it broke structure to the downside here, and this order block had an impulsive move. So this is what I call a pseudo impulsive move, and this order block here rejected off this pseudo impulsive. Let me give another example of what I'm saying. So for example, this is an order block. All right, this is another block. All right, this is another block. Okay, price rejected off this new order block. So let me paint it out so that it can be properly explained. All right, price rejected off this order block, and this order block rejected off this previous order block, which is what I call a pseudo order block. First of all, price must reject off a pseudo order block. Then secondly, that order block must have taken out liquidity previously. And let's look at it before. Liquidity is a very, very, very important concept. It's something that we've touched earlier, and the link would also be in this video, so you can check it out and get more explanation on how liquidity works and what it is. So it must have taken out liquidity before, and this is something, a concept. So let me just zoom clearer so we can see, and we can see here what happened. This order block here took out liquidity of this candle. So there's liquidity resting here, and it took out liquidity of this point. And we can see another concept here again. We can see it clearly. Liquidity taken out here. Look at it. Okay. This candle came and took out liquidity resting above this candle while rejecting off the pseudo block. So while it's rejecting off the pseudo block, it must be taking out liquidity. That is the second concept to point out. Then the third concept that you must discover is that it must have broken structure. Okay, I know I traded it earlier, but it's a third concept that you must take note of. The order block must have broken structure. Yes, the order block must have broken structure. So what do you see again? We can see that this order block broke structure here, and this order block broke structure to this side. So let me point it out for you. It broke structure to this side, yeah, it broke structure. All right, then the fourth concept you must know is that you can then use your Fibonacci tool. Okay, your Fibonacci levels, okay, basically your 78.6 and your 70.5. These are key institutional Fibonacci zones to now take your entries. So for example, let me see how the Fibonacci just coincides perfectly. So you can see this 78.6 or 70.5, okay, 78.6 or 70.5. These are optimal trade entry levels, okay. So once you put your Fibonacci in those zones, you can decide to take entries of those order blocks. So remember the four concepts I said earlier. First of all, it must take out liquidity. Second of all, it must have rejected off a pseudo order block. It must have broken structure. And what happens again? Then you can use your Fibonacci to take out good entry levels, okay. So combining these four concepts together can help you spot the right set of order block. Remember what we said earlier in this video about knowing the order flow and the conditions for discovering a good order block. So at this point, we come to the end of this video, and I hope that I've been able to put you through on how to find the right set of order blocks in the foreign exchange market. I remain Trader Meju, your humble host for now, and do join us same time next week. We'll be releasing a new set of concepts at this period of time. So remember, stay profitable in the market and have an amazing trading week.